There's no follow-up to that.
There's so much to say. People are freaking out, but I can tell you 580 is tough to get. I could go on about it forever.
Hi friends, I am here with Nikki with Unity Home Loans, and we are excited to share and answer some of the most frequently asked questions in the mortgage industry and to learn more about what it takes to buy a home. Here's Nikki. If you wouldn't mind telling us a little bit about yourself, how long you've been doing this for, and just, for us to get to know you better.
Yeah, thanks, Tamily. Hi, I'm Nikkie Taylor with Unity Home Loans, and I've been in the mortgage business since 2012. I transitioned from multiple jobs in customer service and thought this would be the next best fit for me to learn something new. I instantly loved it and never looked back. So I've been a licensed loan officer since 2012 and have helped, not thousands, but hundreds of homeowners over the years. I love what I do. I work for a broker now, so we have many products that can help your clients, whether they're first-time clients as homebuyers, or if they're experienced and they're investors, or maybe someone that would like to move up or move down in buying their home.
Awesome. Yeah. I love it. And you got some experience with you, so you've seen all the different markets that we've had in the last couple of years, the big rush, the lull, and everything. And I love working with Nikki. She's an amazing communicator, really explains the process super thorough with all of our buyers that partner with her. And I'm excited to dive into some of these frequently asked questions.
What loan programs are available for first-time homebuyers?
So for first-time homebuyers, there's a lot of options actually. Depending on what your credit score is and your income levels, I have several options for conventional loans or FHA loans. I also have different down payment options, and those also depend on credit score and income levels. So I have a lot available. It would just be a case-by-case kind of basis that I would love to talk to you about.
Which is great, because if you are looking for some assistance, there's some options for you, just to make it really affordable so that you can get into your first home. And another popular question is, how much should we save for our down payment?
So that varies. We have loan programs that are zero down, up to 20% down, or even more if you'd like to put more down on your home. Just depends on your situation, and I'm happy to go over multiple programs that we have. For instance, if you're looking for zero down, we have an FHA zero down payment program. A VA loan is 0% down. And then we have a conventional loan that would be 3% down as the minimum as a first-time home buyer. Now, as I said, that varies depending on how much cash you do have saved up. And I can work with you if you tell me exactly how much you have, how much we need to put down, plus cover closing costs, all with that amount that you tell me is in your budget. I can also say that if you do less than 20% down, you will have mortgage insurance, unless you do a VA loan. That loan does not have mortgage insurance, but you do have to be a veteran and qualify for that one. But anything greater than 20% down, no mortgage insurance is attached to your monthly payment.
That's awesome. And now to one of my most favorite questions. What's the difference between a pre-qual and a pre-approval, and what is the benefit to either?
Great question, Tamily. So a pre-qualification is when you talk to a lender. Sometimes you do an application for them, and then they pull in all of your information. Basically, they're just taking what you put on the application and analyzing that data, going through it directly with you to make sure that your inputs were correct, and then saying, okay, you're pre-qualified for X amount. Now, a pre-approval is definitely what you want to do. This is what your real estate agent is definitely going to want a pre-approval before they're willing to take you out to look at homes. So a pre-approval, kind of the same process. You do an online application. The lender, the loan officer, which would be me, I analyze all the data. I give you a call. We go over everything, but I also want all of your documents. So I need to be sure that what you stated is correct. So I want to see your pay stubs. I want to see your bank statements. Pull a credit report just to analyze that and make sure that you are in a good position to purchase the home. At that point, once I have all of your documentation and your complete application, I will issue a pre-approval letter to you and to Tamily, and that says, okay, my buyer is ready to go out and shop for homes.
I love that answer and how thorough it was. And not that we don't want to take you out and look at homes, but we really want to put you in a position of power. And we want to make sure that when you do go out and look at homes that you fall in love, that you're in a position where you can write an offer that's going to be backed and definitely take you to closing. The worst thing that we could set you up for failure by not making sure that you're pre-approved, so that we don't have any hiccups along the way, and that when you do fall in love with that home and you're ready to move and write that offer, that you're basically going to get it accepted and all your ducks are lined up in a row. So that's the importance of why we highly recommend that you do have a pre-approval before we start the shopping process.
Correct. And when you speak to a lender, we ask a lot of questions. So if there's anything going on in your credit report that maybe you're not sure about that happened, that does come up sometimes. You don't realize maybe there's some collections on there, or you were an authorized user, say on someone else's credit card, and that's pulling in some numbers that you didn't know were there. Then we can help ratify that so that you're in a good position.
And that's exactly what we want for you, to be in a good position so you can move forward. Another great question is credit scores. How does my credit score impact my home loan and interest rates?
So it really impacts it. What we do when we pull a credit report, we want to look at your credit profile, and we pull from all 3 credit bureaus, from TransUnion, Equifax, and Experian. We take the middle score. So what we're looking for on a conventional loan, the middle score needs to be at least a 620. And on an FHA, we can go down to 580. That is the bare minimum. And you don't want your score that low. It's a possibility to get an approval, but it's a lot tougher, I'll tell you that. So the higher the credit score, the better. 620 for conventional. If you want to do a down payment assistance program, you need to be in the 640 to 660 range as a minimum.
That's awesome. And just a follow-up question, because I know that sometimes I get this question asked, that the higher your credit score, it's almost like a tier level service, that if you're in between this bracket, then your interest rate could be lower depending if you're higher than those minimum 620, 640.
Correct. So the higher credit score, it usually goes in about 20-point increments. So the higher the credit score, the better the interest rate. It's going to be a lower interest rate versus, say, if you have a 740 credit score versus somebody with, say, a 680, you're in the 700s, you're going to have a much better interest rate. So it really helps your payment, because the interest rate affects your monthly payment. That means your higher credit score, you're going to have a lower monthly payment.
And we all want that.
Yes.
All right, story time. I have a buyer that's pre-approved, and they want to know, what is their timeline on getting approved? And
okay, so once they're pre-approved, then you're going to go show them homes. You're going to put an offer in on a home that they love. Once that's accepted, we can close in as little as 3 weeks. Just depends on what the seller and the buyer agree to.
Awesome. So if we need to get something done, done quick, 3 weeks, or if we need to negotiate for more time, at least we have some guidelines of how fast we can move.
Yes, correct. And that's for any loan type that we do, 3 weeks, and even we've done some in a couple weeks, just if we can move quickly. So
yeah, that's awesome.
We can do short closings, absolutely.
Thank you. And that is super great, especially when you're in a competing offer situation, that line item, as far as like getting a quick close time, can make your offer swing to get accepted when you're in a multiple offer situation. So having a lender that can close quickly is definitely to your advantage.
Yes, and that's another reason why when we do a pre-approval, we collect all of your documents right away. Sometimes buyers feel like it's kind of a hassle up front, but if I already have your pay stubs, your W-2s, your bank statements, then I have everything I need, so that when you do go under contract, it gets submitted to underwriting and we're ready to go from that point on. It's very quick. That's why.
I love it. And speaking of underwriters, because a lot of times people have this like vision in their head that they're locked up in a dungeon somewhere. How important is it to understand like the relationship with the underwriters and how close they are if they're local, and how important it is to work with a local lender that knows the market, but has a team that can help and assist?
Yes, so we have a team that we work with directly, and they're amazing. We have constant communication, which is great. We don't have the underwriters, as you mentioned, that are scared and they're hiding behind their desks that no one can get a hold of. We can easily chat with them through computer. We can call them and they get back to us immediately, because you have to understand also, so they're working for a lender. They want to get your loan closed just as much as we do. So we all work together as a team to get our goal of buying your first home or your second home, whatever it may be, quickly and efficiently.
Awesome. You spoke about this earlier, and just a little bit of more clarity with mortgage insurance, which sometimes is typically known as PMI. Can you help define that, and when is that due, or what loan would that apply to?
Sure. So that's going to apply to any loan when you're putting less than 20% down. It's going to vary. So it varies depending, again, on your credit score, what your debt to income ratio is. All of the numbers within your loan profile determine basically what the PMI is going to be. And I will tell you that different lenders have different private mortgage insurance, PMI loan companies, or companies that they work with that gives them different rates too. So not every lender is going to have exactly the same rate on that on a conventional loan. The number may vary slightly, but we do our best to get you the lowest rate possible for that. It's included in your loan payment, your mortgage payment each month, so it's not a separate payment that they have to make. It's all one payment.
Awesome.
Now for FHA, it's a standard amount. So in an FHA loan, it's just a standard amount that's always going to be on the loan.
And just to really dig deep on that, the difference between the two, since on the FHA is a standard amount for the life of the loan versus a conventional where if you get into a certain amount of equity, that it can fall off. So can you give us a little bit of explanation on when does it stay for the life of the loan and when could it possibly fall off?
Yep, so FHA, if you do 3.5% down, which is their minimum, it stays for the life of the loan. If you do more down, then there's different ranges. So it can stay 11 years or for the life of the loan, depending on your down payment. FHA loan also, if you end up needing an FHA loan, even though you're doing 20% down, you have mortgage insurance for the life of the loan. There's no option to not have mortgage insurance on an FHA loan.
And then for conventional?
And for conventional, so your mortgage insurance is going to vary depending on if you're putting 3% or say 19% down. Obviously, the more you put down, your mortgage insurance is going to be a lower amount per month. But that does stay on the loan until you have 20% equity in the home.
Awesome.
If you put less than 20%.
And does that mean that you would have to refinance on an FHA to get the mortgage insurance off?
Yes, so on an FHA loan, you would refinance, if possible, into conventional loan once you have 20% equity in the home, and that would not have any mortgage insurance attached to it.
Does that mean you have to refinance for a conventional as well?
So conventional, you do not. Typically, the lender will just require an appraisal on your property to make sure that you have that equity of 20%, and then it will drop off. You request that from the lender directly. Now, if you're making your regularly scheduled payments on a conventional loan and you automatically hit that, it's a 78 to 80% loan to value, so about 20% equity basically, it's going to automatically fall off. You don't have to request it being dropped by the lender. They have your payment schedule and they see when that loan amount gets to having enough equity versus the purchase price.
Thank you so much for explaining.
So it's a little confusing.
Yeah, and a lot of this is a great question because again, like depending on the loan program that you pursue, these are different options down the road that you need to be aware of.
Right.
Okay, Nikki, tell me about first-time homebuyer programs or any grants or anything that's available to them.
Sure. So as I mentioned previously, we do have a zero down program for first-time homebuyers. We also have the minimum 3% down for first-time homebuyers for a conventional loan. There are some grants available if you live in certain zip codes that can give you about $5,000 towards down payment and closing costs. And sometimes we have some Florida-specific programs that come out as well, some bond programs and so forth. Those you have to work with a certain lender that actually is qualified to offer that program though. So at this time, I don't have that, but I've heard that they're kind of hard to work with and hard to qualify for, but it is an option out there in the state of Florida. We also have Hometown Heroes that comes out every year, and that's a great program as well for first-time homebuyers. So you have to be employed in the state of Florida, and your actually job location has to be based in Florida. So some of the larger companies that may be a little harder to qualify for because it could be a company based in, Washington State, and that wouldn't qualify unless you had an office address in Florida.
So the employer has
to be in Florida with a local address
to get qualified for that loan.
Yes, correct.
And interesting about these down payment assistance programs and also these grants that are available and these other down payment assistance. a lot of times it's a second mortgage.
Yes.
Can you share, the difference between, if it's forgiven or it's for the life of the loan, and explain that a little bit?
Yes. So some of these down payment assistance programs, as you're researching them, a lot of them, as Tamily said, do come with a second mortgage. So what that means is your first mortgage will be like the 3.5% down, as I mentioned, that we can give as the zero down, because basically the program's covering your 3.5% down payment. Now, the other 1.5% can be also part of that to give you a full 5% down. Now, whether you do the 3.5% down just for the down payment portion, or you want to include the extra 1.5% to cover some of your closing costs, is the 5%. That entire portion is considered a second mortgage. So you'll have your first mortgage that's going to cover the loan amount, and that is going to be, say, an interest rate for FHA about 6.5%. Your second mortgage, whether you take the 3.5% or 5% assistance, is going to be, I'm just going to say, about $12,000 that you could be borrowing, okay? That is considered a second mortgage, and most of the time is going to be included as a payment in your monthly mortgage, okay? So you won't have two separate loans. It's all going to be one loan. The second mortgage rate, though, is at 9.99%, and you're making payments on that $12,000 as an example. And it's basically you pay on it each month, and if it's not paid off in 10 years for the program that I offer, then you owe that as a lump sum. Also, you cannot refinance, sell the home, or change ownership of the home. If you do, then that $12,000 that you borrowed becomes due and payable as a balloon note.
Okay. So it's important to understand these options. So when you're looking for down payment assistance or grants, if that loan is going to be there until it gets paid back with your monthly payments, or if you do decide to refi or sell, that it will be due once that new note is made.
Correct. And then also some of them do have a forgivable option. The forgivable option for the FHA product that I have is 5 years. So if you make on-time payments for 5 years of your first mortgage, there's no monthly mortgage due on that second mortgage. But you make 5 years, 60 months of continual on-time payments, then that loan is forgiven in 5 years. So that option is forgivable. Again, you cannot sell, refinance, change ownership of the home, or that becomes due and payable before the 5 years. At the end of the 5 years, that just goes away. It's forgivable. At that point, you can move on and do what you'd like with the property. That one does come with a higher interest rate, though. So they kind of hit you for, the forgivable part. Some of my buyers like to do the repayable option, which has a lower interest rate for the second mortgage, and they're making very small payments on that throughout the term of the loan.
Okay. So again, super important to have these conversations with your lender just to see what your options are, because let's say if this is your first time home, as we know, our family dynamics change, we grow, we need to sell that property and get into something. You need to really calculate how long you're going to be at that property to see which one's going to be the best fit for you.
Correct.
And that's the perfect transition to our next topic, which if you are that buyer that purchased that home, your first time home in that $400 price range, and now you're looking to sell because your family changed and it grew, and now you're looking at a home that's over $800, there are different loan programs available to you. And if you could share some insight on what they are and what we need.
Yeah, so we have jumbo loans. So basically what that means is if you are purchasing a home and you need a loan for anything greater than $806,500, it's considered a jumbo loan. Now, I can tell you, you need to keep in mind that that is not the purchase price, that would be the loan amount. So any loan amount that's going to be over that $806,500 is considered a jumbo loan. There's different qualifications that you need to meet in the jumbo loan world, yes. So the minimum credit score is 700 for those. And your debt to income ratio is going to depend greatly on what your actual credit score is as well. So typically a jumbo loan can go as high as 43% for debt to income ratio. And if you're a little bit credit scores on the lower end of the things, so probably that 700, you're going to have to meet about a 35% debt to income ratio. So it's a little tighter. They want to make sure that it's not a risky loan at all. So they need to make sure if they're lending you, the $806,500, that you're going to be very well qualified to make those payments and not default on the loan. Another thing to keep in mind is if you're self-employed, there's some tighter restrictions as well if you're looking into a jumbo loan.
Okay, awesome.
Yeah.
And talking about self-employed, I know that that's also a hot topic. What are some qualifications when we're looking, and this is for any purchase amount, when you are self-employed, when you're looking to get approved for a loan?
So self-employed, that's a whole different ballgame as far as qualifying. It's not difficult to do as long as you have all your paperwork in order. So we will use the last 2 years of your tax returns, and we will take your net income, and then we divide it by 24 months. So basically you give me 2 years of your tax returns, we combine your net income, we divide that by 24 months, and we use that as your monthly income. Some things can be brought back into the loan. So if there's any, some of your write-offs and so forth, depreciation, we can write back in to qualify you for the loan as far as income goes. But it's basically 2 years tax returns. And if you were in the middle of the year, so say now we're in 2025 and we start going through the year, we're also going to want 2025 P&Ls and balance sheets as well, just to make sure that your business is on track to do what you were doing in the previous years.
Awesome. So you can still qualify, but just know there's some additional paperwork, and we got to make sure that you have all that lined up and ready to go for you to buy.
Yes, and also if you are having a hard time qualifying with your tax returns, because a lot of businesses do write off pretty much everything and their net incomes end up being very low. But if you have a substantial amount in your bank accounts, then we can do an asset depletion loan for you. So we can take a look at your assets, your bank statements, and qualify you for a loan that way and not even bring your income into it.
That's a great
So we have a lot of options.
That's awesome to hear. All right, Nikki. Interest rates. So how do they impact my loan?
So great question. And this is always the question we get, right? Everyone wants to know about this. So interest rates are going to be very dependent on your credit scores. So they're directly correlated to that. So right now they're in the low to mid 7s. I can tell you for FHA, your credit score is going to, you can have a lower credit score for FHA, but the interest rate's always lower for FHA as well. So you're looking like 6.5% there. But as I always tell people that are worried about interest rates, you do not want to wait to purchase a home, because what happens is demand starts growing. Tamily's going to have multiple offers. Price of the homes are starting to go up already. If you're paying $20,000, $50,000 more for a home, then you want to go ahead and do it at the 7 whatever interest rate right now, because if you have to pay more for the home, your payment's going to go up because you're spending more on that home.
So important, when all things need to come into fruition and take into consideration and factor that if you want to get into a home and you can afford the payment, just go with it now versus having to compete and pay more for the home. And if we start getting into that multiple offer situation again, where you're offering even more for what they're asking for, your payment is just going to be so much more higher.
Correct. And we also offer, you can buy down the rate on any of our loan programs. So if you're concerned that, that interest rate's just a little bit too high, I have several options for you always to purchase points, meaning that buy is a one-time fee that's just added to closing costs, and that helps your interest rate be lower for the term of the loan. So, say for $2,000 at closing, you can purchase a half a point. I'm just putting an example out there. And that stays that lower payment at that rate that you chose on a 30-year fixed mortgage, if that's the loan program you chose.
Awesome.
So there's always options.
That's perfect. I love that you have that availability for them. So for instance, that would fit perfect for a current home seller that's selling their home. They have a lot of equity in their home. They can use those gains not only for their down payment, but use that additional funds to buy down that rate.
Yes, correct. And when I talk to buyers, we also talk about what your budget is for your monthly payment. And we'll start talking about buying down the rate and if that makes sense for you in the long term, and how much it's going to take you how many months it'll take you to make up that payment that you're using for the points. So if you spend $2,000 in your monthly payment, how many months is it going to take you to recover that so that it's your break-even point, right? So that you feel good about that and you have your monthly payment where you want it to be.
I love how you explain that, because a lot of times when we are thinking about buying down the rate, you got to take into consideration how long you're going to be at the property and if it makes sense to pay that up front, because basically what you're doing is you're paying that interest up front at the time of closing so that you can save it with your monthly payment down the road.
Yeah.
So You shared a lot of great insight on that last question, and another great one that sometimes me as a consumer, as a buyer, and even my clients ask, like, how quickly should I lock my rate or should I float it? What are the pros and cons to those?
So I think that once we have the purchase contract and we know what your closing date's going to be, and that's a pretty firm date, then that's when we know the term of how many days you're going to need to lock in your rate. Say it's a 30-day closing, 45-day closing. I would definitely recommend locking in your rate. It's a very volatile market, as we know, and everyone is, very concerned with interest rates going up and down. And what if I lock now? And what if the rates go down? Well, I can tell you we have lenders that I work with that will help with that. If rates go down by, say, 0.5 point, they will float it down for you at no cost. Sometimes there's a cost involved. It just depends what's happening with the market. But I always recommend to go ahead and lock in the rate, because if you float the rate, meaning that we have not locked an interest rate, then that rate can change, and the day you lock it is dependent on what the market's doing. So rates can be much higher, and you cannot go back to the last day. So it's current market, what that rate is that day, and at that time, if you float the rate and decide to lock it in. The market also changes several times through the day, so there can be reprices up or down every single day. So it's very it's a gamble. It definitely is. But I would definitely say lock in the rate. The only time I would say not to is maybe if you have a 60-day close, because if we have a 30-day rate lock, that's going to be a better interest rate than, say, a 60-day rate lock. So 60-day, I might say, let's take a little time. Let's kind of watch rates and see what happens over the next, few weeks and go from there. Yeah. If it's a new build, we definitely don't want to lock in any interest rate because we don't have a closing date yet. And as we all know, with new builds, closing dates can shift depending on, supply and demand of getting product in, weather, anything.
Anything that can
So we don't want to, for a new build, absolutely do not lock it in until we have an actual closing date from the builder.
These are some great pointers. So just know, listen to what's happening depending on your time frame, and if you do have that 30-day window, definitely highly recommend to lock it. And if you have longer, then you have a little bit of more time. But again, everything involves risk, and you need to understand that risk depending on the situation.
Yes.
So now that we have our interest rate locked, what are some additional fees that we could discuss or we need to be aware of when it comes time to close?
Great question. So there are a lot of extra fees involved. And these are necessary fees. There's really no option for negotiation because these are considered third. So basically, we work with a title company to close your loan. They're going to have their own closing costs involved. They have to do a title search. They have to pull several policies in. There's taxes involved with that. In Florida, we have transfer taxes on the property. So they have their own set that comes to closing with us for fees. We also want to talk about your taxes and insurance. So your property taxes, depending on what month you're closing, will be due at closing. I say depending on what month, because once the seller's lived in the home for a certain amount of time and they have already prepaid their taxes, then you'll get a tax proration based on that. So that's really dependent on your closing date of when you're going to, how much taxes you have to bring to closing. And then your homeowner's insurance. You are free to shop for your own homeowner's insurance policy, but anytime you purchase a home, there is 1 year that you do pay up front at closing or to your insurance company directly. And we just get a paid receipt stating that you've paid that 1 year. And then you also have to bring about 3 months to closing if you're doing an escrow account. So that helps just start your escrow account so that next year, when your bill is due, that the lender has enough in that account to pay out that bill in full again, because your homeowner insurance is typically due 1 time per year. You also have interest on the loan, so that is calculated on your loan amount times your interest rate and how many days left in the month. So basically, if you close on the 15th of the month, it goes from the 15th of the month to the first day of the following month. So you have 15 days of interest there. And I think that's about it.
That's awesome. Yeah. And all these figures will be discussed with you at the time of closing before you sign, so that you're fully aware of what you need to bring to the table, what's going to be due, and all the different amounts and who gets what, so that you guys can have a successful closing.
Yes, and when we do a pre-approval, I actually will give you an estimate of all these fees so that you have a rough idea of what's going to be due at closing. And I always let everybody know that these fees will change slightly depending on, the title company once we get all their fees in, once we know exactly when you're closing, once we get your homeowner's insurance policy, the taxes. Once everything gets defined and we have a better idea, then that's when Tamily said we will send you an actual closing disclosure stating what the final fees will be. But I like to at least give buyers a heads up in the beginning of the process so that they can feel comfortable with how much they could be bringing to closing.
And I love that. And that's why it's so important to set the expectation, just set what we're going to be doing so that there are no surprises later down the road.
Yes.
Full transparency. So for underwriting, how long does it typically take to get a loan approved?
So this is actually pretty quick as long as you as the buyer are helping us and make it efficient. So I should have all of the information up front, as I mentioned with the pre-approval. I have your documents. So we submit over to the underwriting department. They turn it around, review it within 24 hours. Then they give us back a conditional approval. And then they might say, hey, we need an extra pay stub from this specific date, or maybe your bank statement wasn't clear, something like that. Then we go back to you as the buyer and say, we need these couple items. Can you please get that back to us? If you work with us and get it back to us very quickly, then we return it back to the underwriting team. They review it within another 24 hours, and then you're free to close if they have everything. So that's why we can close so fast.
I love it. So 24-hour turnaround anytime there's something that's required for review.
Right, correct. Yes.
Fantastic.
It can be a fast process.
So let's throw a curveball. Let's say I decided to get a new job. How does that affect my loan application and getting approved?
So you please tell me right away if you're thinking of making any changes, but it can be okay. So that's why we want to know right away, right? So it depends on what the job's going to be. If you're going to stay pretty much in the same line of work and maybe you've got a raise to go somewhere else, right? An improvement in your salary, then that's okay. We just want to see an offer letter since it's a brand new job to see exactly what you're going to be making, because you have to stay full time. And we need to show when your start date is. There shouldn't be any gaps in employment, right? If you're in transition with a loan, we need to make sure that you're going right to that new job with the salary that you were hopefully making or greater. You don't want to go from being employed with a company like a W-2 employee to starting your own business or receiving a 1099 from another company, because that makes you self-employed, and then you need a 2-year history that you can qualify for a loan when you're self-employed. So that's a big red flag. So it's okay if you take another job in the loan process. We don't advise it, but you can work with that as long as you're transitioning with the same amount or a higher salary. Now, I have had situations where they are receiving less pay, and as long as it qualifies and your debt to income ratio still is workable for the loan, then that's okay. Again, we don't want to see it happen because that's a little scary for everyone, because we want to make sure you purchase your home in the end.
Absolutely. So the importance of communication and transparency, again, you're here to help them and guide them and making sure that they get to the closing.
And please tell us, because if you don't, we find out. So if you change, because we do verification of employment at the very beginning of the process and at the very end, like literally right before closing, within a day, we call your employer to make sure you're still active. So we need to make sure you're active to close on a loan.
And let's wrap up with some great advice to someone that is either first time buying a home, or they're doing a move up, or they're even selling to purchase something smaller. What are some things to avoid so that we can have a successful closing?
So always reach out to me to go over the full scenario of what you're thinking about, what your employment is, if you're thinking of switching jobs, just everything that's going on in your life I need to know about, please. And then I can guide you of the do's and do nots along the way. If you need help with credit, if I have someone that can help you with credit repair, if you need to get your scores higher, if you need to get some things off your credit report to qualify. If you need to know how much money do I need to make to qualify for this home, then I can give you a scenario on that. For people that are wanting to sell their home, my biggest advice is please get pre-approved for your next home before you put your current home on the market. Because some people think that, okay, I own a home, I'm fine. Like, I've made these mortgage payments for 15 years. I shouldn't have an issue qualifying. But in my experience, I've had some crazy things happen, and that's one thing that happened where they couldn't qualify for the next home, and they had already listed their home. So then they ended up having to sell their house and move into a rental.
So important
So talk to a lender.
Let's share all the possible scenarios so that we can get there.
Yeah, absolutely. Don't hide anything. Tell me.
Better to
confidential.
disclose than to.
Yes, and it's
have
confidential,
surprises.
and I can give you advice of what you need to do. Or if you're in a great position, that's perfect. Let's get you set up.
Thank you so much for all
Thank
of your
you.
help today. This has been super insightful. And if you could let us know where we can find you, and if you have any questions or need some one-on-one time to see what's your next move, call Nikki.
Yep. So my direct line is 614-747-6149. My email is Nikkie, Nikkie, @unityhomeloans.com.
Awesome. Thank you so much
All right.
for
Thank you.
today.